Welcome back to Ben's Book Club. Today we are diving into the book A Random Walk Down Wall Street. I am absolutely pumped to guide you through this explainer. Burton Malkiel's classic premise here completely demystifies the stock market. We're going to break down exactly why trying to outsmart Wall Street is almost always a losing game and how you can actually win big by keeping things incredibly simple. Let's just get right into it.
Malkiel famously argued that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. I mean, just think about that for a second. It completely shatters Wall Street's ego, right? It breaks all those illusions of expert control. This single, provocative analogy is a massive part of what helped launch the entire index fund revolution.
Okay, let's dive into this. Section 1. Wall Street's two big illusions. We'll look at the myths financial experts use to claim they can consistently beat the market.
So we have this classic battle of investing philosophies. On one side, fundamental analysis. This is the firm foundation theory of finding intrinsic value through a company's earnings. And on the other side, technical analysis, or the castle in the air theory, which is all about predicting crowd psychology and future moves by looking at past price charts. Now, Malkiel is highly skeptical of both, but he literally destroys technical analysis. He basically calls it the financial equivalent of astrology.
The core issue here is that by the time an analyst actually finds a bargain, the market has already adjusted the price. It processes new information instantly. So identifying undervalued stocks consistently is incredibly difficult in practice. Add in the drag of taxes, human mistakes, and those hefty management fees, and it becomes virtually impossible for active managers to consistently outperform the market average over the long run.
Moving right along to Section 2, A History of Market Madness. Because to understand the market, we have to look at why human irrationality always overrides logic. Tracing through history gives us this fascinating, kind of wild tour of financial manias. Way back in the 1630s during Tulip Mania, a single tulip bulb cost more than a luxury house. Then in 1720, the South Sea Bubble had people investing in a company that literally stated it had no known business purpose. Fast forward to the 1929 Wall Street crash, and then the dot-com crash in the 2000s, where simply adding .com to a company's name tripled its value overnight, regardless of actual revenue. The grand lesson here? Whenever the crowd starts thinking, this time is different, it always ends in disaster. You see, the true enemy of investing isn't a lack of financial knowledge. It's our own behavioral traps. Overconfidence, herd behavior, pure greed, and chasing hot trends, like we've seen recently with meme stocks, are what push people into bad decisions. They cause us to buy high on the hype and sell low in a total panic.
Now let's shift gears to Section 3, the random walk reality and how to navigate unpredictable markets.
This brings us to the academic reality behind this explainer, the efficient market hypothesis. Because thousands of highly motivated professionals react to news instantly, stock prices already accurately reflect all available information. When news breaks about a company, very smart people instantly buy or sell, adjusting the price in a matter of seconds. Because of this, short-term price movements are completely random and unpredictable noise. You simply cannot outknow the collective brain power of the entire world.
0. That is the exact number of times a stock's short-term price movement today can reliably predict its price movement tomorrow. Short-term movements are entirely unpredictable. Malkiel actually compares it to a drunk stumbling down the street, a truly random walk. There's absolutely no reliable pattern for you to exploit.
So, the crucial point is, how do we use this? Section 4, the Malkiel Index Strategy. Let's look at how to actually win as an everyday investor.
Here are Malkiel's rules, and while they might seem a little boring at first glance, they are absolutely brilliant in their effectiveness. First, minimize your costs and fees. This is his biggest recurring drumbeat, because fees will quietly eat away at your returns over time. Second, diversify broadly across asset classes. Don't put all your eggs in one basket. And third, adjust your asset allocation based on your age, which usually means shifting more towards stable bonds as you get older. Hammering home these rules, keeping your fees super low, and ignoring the daily market noise is how you actually build lasting wealth.
To execute this strategy, here's exactly what you do. Step 1. Buy broad, low-cost index funds. Step 2. Use dollar-cost averaging, which just means you invest a set amount on a regular schedule to completely eliminate the risk of timing the market poorly. And Step 3. Rebalance periodically to maintain your target risk level. Malkiel was a primary inspiration for the creation of retail index funds for a very good reason.
If you can't beat the market, your absolute best move is to simply be the market.
As we wrap up this explainer, I'll leave you with this. Are you still trying to sprint against Wall Street, or are you ready to take a random walk to lasting wealth? The market is a random walk, but the march of human progress goes up. Stop trying to outsmart everyone, embrace the beauty of the index fund, and let compounding do the heavy lifting for you. Subscribe so you don't miss an episode.